Synopsys just posted a massive double beat for Q3 fiscal 2026.
Yeah, they really did. Revenue came in at $2.477 billion.
Which is like a 42% surge year over year.
Exactly. And non-GAAP EPS hit $3.91, easily clearing the $3.67 consensus.
Right.
And management actually raised full-year guidance across the board, too. So revenue is now projected up to a range of $9.69 to $9.74 billion.
Okay.
And non-GAAP EPS is bumped up to $15.04 to $15.10.
So a double beat and a raise across the board, yet the stock slipped, 1.4% in after-hours trading?
Yeah, falling to $404.25.
Right. So today we're taking our stack of sources, the Q3 earnings report, the segment data, and the management call to figure out exactly why Wall Street is punishing a seemingly stellar quarter. And really what this actually tells us about the underlying economics of AI chip design.
Well, I mean, to understand the sell-off, we really have to look at where this 42% revenue surge actually came from. So the design automation segment that generated $2 billion this quarter.
Wow, $2 billion.
Yeah, which represents 81% of their total revenue.
Okay.
And it's running at a remarkably high 45.2% adjusted operating margin.
That is massive. But we have to factor in the reality that a huge chunk of this top-line growth is just a direct result of Synopsys absorbing Ansys.
Right, from that recent $35 billion acquisition.
Yeah, exactly. Because, to give some context to how these two fit together technically, if Synopsys is the software that designs the literal blueprint for a next-gen AI chip, then Ansys is the physics simulation software that tells you if that chip is basically going to melt when you actually plug it into a server.
Right, exactly. Synopsys is trying to sell the entire end-to-end factory to chip makers.
Yeah, it's like a high-speed corporate engine swap. The top-line horsepower is clearly there, but investors are sweating the mechanics bill.
Oh, for sure. And it is a brilliant strategic move to capture the whole market, especially when you look at their other segments.
Right.
Like their design IP division, which licenses out pre-designed chip components, that bounced back to 11% year-over-year growth.
Oh, nice.
Yeah, it brought in nearly $473.8 million at a 26.5% margin.
Okay, so the core business is absolutely humming.
It is. The issue investors are hung up on isn't the theory of the merger. It's the immediate execution cost of stapling a $35 billion company onto their existing framework.
Which CEO Sassine Ghazi really hammered on during the call.
Yeah, he did. He argued that AI is driving unprecedented complexity in silicon.
Right, meaning customers desperately need this combined platform.
Exactly. The demand is clearly there. But absorbing a behemoth like Ansys isn't just a plug-and-play software update.
No, definitely not.
Far from it. We're seeing the friction show up immediately in the form of a newly initiated restructuring plan.
Oh, yeah. Management expects what, $425 million to $500 million in charges?
Yeah, somewhere in that range.
Right.
We're talking workforce reductions, closing overlapping site locations.
Right.
Essentially just trimming the fat to make the combined entity efficient.
So a $500 million mechanics bill just to get the new engine running. Plus, they took on significant debt to pull off the Ansys deal in the first place, right?
They did. Though I know they recently paid down $4.3 billion of it.
Right. But that remaining debt load is still sitting heavy on the balance sheet. Add in the macroeconomic risks, like, tightening U.S. export controls on chip technology, and you can see why the market is acting so skittish.
Exactly.
Okay.
And that debt load and the restructuring effort, well, it feeds directly into the underlying tension in this earnings report.
Which is?
The massive gap between GAAP and non-GAAP realities.
Oh, right.
Because non-GAAP margins look phenomenal, right? Over 41%.
Yeah.
But the GAAP operating margin actually plummeted to just 14.4% this quarter.
Okay, well, let me push back on Wall Street's reaction here, because are retail investors just being totally short-sighted?
How so?
I mean, if you're selling off on a 14% GAAP margin, aren't you missing the fact that under GAAP accounting, Synopsys is forced to write down the value of things like Ansys's brand and patents over time?
Well, yeah, that's true.
That amortization looks terrible on paper, but it's not actual cash going out the door today.
Right.
So it feels like the market is panicking over an accounting quirk and a one-time restructuring charge while just completely ignoring a 42% real-world revenue surge.
I hear you. It's the classic post-merger earnings trap, though.
Yeah.
Institutional investors look at free cash flow, and they generally model out these non-cash integration costs.
Okay.
But the broader market, and frankly algorithmic trading, tends to flinch at immediate drags on GAAP profitability.
Because Wall Street hates uncertainty.
Exactly. And right now, Synopsys is asking the market to trust them while their garage is completely torn apart.
They want credit for the shiny new race car, but investors are just staring at the wrenches and oil spills on the floor.
Right. I mean, Synopsys has practically monopolized a critical layer of the AI infrastructure stack.
Mhm.
But in the short term, they have to prove they can consolidate this massive new workforce without burning up the cash flow that made them so attractive in the first place.
Which really leaves you with a huge question about the long game.
Yeah.
As AI chip design complexity compounds exponentially, right, doubling or tripling every single year, will Synopsys' aggressive cost-cutting actually be enough to protect their targeted 41.5% fiscal year 26 operating margin?
That's a tough balance.
Or will the ANSYS integration frictions just drag them down next quarter?
Yeah, that's the real test.
We will have to see how long they can keep up the sprint. Be sure to follow the show for your daily earnings coverage.